As of the final closing bell on Friday, May 15, 2026 at 4 p.m. Eastern Time, Micron Technology Inc. closed its regular trading session at exactly $724.66 per share, marking a significant intraday downward movement of negative 6.62%, which stripped away $51.35 from its valuation in a single day of high-volume selling. While the headline numbers suggest a simple, aggressive profit-taking route across the semiconductor landscape, the reality buried deep within the order flow reveals a structural shift that almost nobody anticipated. The massive drop on Friday was not just a sympathy move tied to broader technology weakness, it was a localized leverage unwind triggered by the high-profile political dynamics of the recent bilateral summit in Beijing. While ordinary market participants watched the headline index numbers slide, the largest institutional players were aggressively recalibrating their positions because the expected high-volume purchases of specialized computing architectures by international enterprise customers completely failed to materialize. This created an immediate supply chain air pocket that directly threatens the near-term pricing power of advanced memory components, introducing a sharp element of friction into a sector that had previously seemed entirely unstoppable. The common consensus surrounding this enterprise has been remarkably uniform over the past few months. Walk into any discussion about the current chip boom and you will hear that memory capacity is the absolute bottleneck for every major computational cluster on Earth. Investors have operated under the firm belief that as long as giant processing units are selling, this enterprise will continue to print unprecedented capital because every advanced logic processor requires massive blocks of high-bandwidth memory to function without crippling delays. This narrative pushed the stock from a low of $90.93 up to a staggering lifetime high of $818.67 just days ago. But this conventional wisdom ignores a basic truth about the hardware business. The underlying market is historically one of the most volatile commodity cycles in existence, and the assumption that the structural demand will permanently override the structural capacity additions is now facing its first real test. When the market narrative expects a flawless multi-year runway, even a microscopic delay in international deployment can cause massive structural damage to the equity value. This specific intraday drop on Friday, which saw the stock plummet from an opening print of $732.57 down to a low of $719 before settling slightly higher, was driven by a sudden realization regarding global asset distribution. Institutional trading desks spent the entire session processing data from the latest diplomatic discussions, where it became clear that major global tech enterprises were pulling back from expected purchase agreements due to domestic compliance pressures. This directly impacted sentiment for related semiconductor heavyweights, as traders realized that if the core compute engines face a temporary demand ceiling in major international regions, the specialized memory modules designed to sit right alongside those engines will inevitably pile up in warehouses. The absolute trading volume during the session surged well above historical averages, confirming that this was a coordinated institutional exit rather than a minor retail panic. When you see billions of dollars in equity value move out of a dominant hardware player in less than 6 hours, it tells you that the collective market assumption regarding infinite frictionless expansion is being aggressively dismantled. When evaluating these aggressive swings, it helps to put things into perspective by looking at the broader landscape of modern digital finance platforms. Investors managing their own capital through tools like a Robinhood account or a SoFi individual brokerage often experience intense anxiety during these sharp 6% pullbacks, scrambling to figure out whether to protect their capital or buy the dip. The sharp divergence between long-term institutional accumulation and sudden retail liquidations is highly visible across the board today. Whether you are building a long-term strategy using Schwab Intelligent Portfolios or executing short-term options trades through the Interactive Brokers platform, navigating a highly cyclical hardware stock requires an entirely different playbook than holding stable software as a service entities. Platforms offering comprehensive investment help often highlight the extreme volatility of this specific asset class, because memory pricing can swing from severe shortages to massive gluts based on a few minor adjustments to capital expenditure plans by the top 3 global producers. To understand the core mechanics of this enterprise, we have to look closely at its baseline operational model. At its heart, this firm designs, manufactures, and sells advanced semiconductor memory solutions, primarily split between dynamic random access memory, which provides volatile high-speed data architecture for active computational processes, and flash storage, which handles non-volatile long-term information retention. The fundamental business logic is entirely dependent on global computing infrastructure. In their recent second quarter financial report for fiscal 26, which landed in mid-March, the company shocked the street by posting an absolute revenue figure of $23.86 billion, a massive jump that nearly tripled what they achieved in the same period a year prior. Net margins flew up to an incredible 41%, driving a quarterly profit that reached billions of dollars. This incredible performance was anchored by their proprietary high-bandwidth memory modules, specifically the HBM3E architecture, which boasts 50% greater capacity and 30% lower power consumption than legacy competing products, making it the preferred choice for top-tier accelerator platforms globally. However, the core issue that creates the brutal expectation versus reality mismatch is the inherent structure of memory manufacturing. Unlike specialized logic processors that are built to custom order, memory chips are fundamentally dense, high-volume hardware components. The manufacturing facilities require tens of billions of dollars in upfront capital commitments to construct, and once those facilities are active, they must run at absolute maximum capacity to cover their fixed costs. This creates a terrifying historical pattern. When supply is tight, prices skyrocket and margins expand into the stratosphere, which is exactly what drove the stock up 700% over the past year. But those exact same high margins incentivize every competitor in the space to rapidly expand their own production facilities. The moment that new capacity comes online, or the moment that large-scale corporate data center construction slows down by even a fraction, the market suddenly finds itself flush with excess silicon, causing spot prices to collapse just as fast as they rose. Let's pause here for a moment to gauge the sentiment of the community. Comment below how many shares of Micron Technology Inc. you currently hold, and let us know if you are using this latest 6% drop to add to your long-term position, or if you are looking to rotate capital into safer asset classes. Looking forward into the remainder of fiscal 26 and heading toward 27, the entire forward valuation of this enterprise hinges on a delicate balance between absolute production constraints and real-world deployment speeds. Wall Street is currently caught in a massive internal debate regarding where the top of the cycle actually sits. On one side of the ledger, ultra-bullish analysts at institutions like Deutsche Bank and D.A. Davidson have maintained aggressive $1,000 price targets, arguing that the global structural shift in computing architecture will require so much memory that the structural shortage will easily last until the end of the current decade. They point out that the upcoming transition to next-generation HBM4 architectures will introduce even greater technical complexity, which should naturally limit supply growth and keep contract prices elevated for the foreseeable future. But the contrarian reality, which began to manifest clearly during Friday's sell-off, suggests that the market may have priced in an absolute best-case scenario that leaves zero margin for execution errors or geopolitical disruptions. Even though management explicitly stated that their entire production capacity for the remainder of the calendar year is completely sold out under firm contracts, those contracts are only as solid as the financial health and regulatory freedom of the purchasing clients. If global trade barriers tighten further, or if major tech conglomerates decide to stretch out the life cycle of their existing data center hardware rather than upgrading to the newest platforms every single 12 months, this enterprise will immediately bear the brunt of that capital expenditure reduction. The forward price-to-earnings multiple currently sits at an optically cheap single-digit figure, but seasoned memory analysts know that a low multiple in a highly cyclical industry is frequently a classic trap, signaling that earnings have reached their absolute cyclical peak and have nowhere to go but down. As you look at your own personal asset allocation, whether you are managing a self-investing account through traditional online investing tools or utilizing sophisticated robo-advisory algorithms, understanding this structural tension is essential. The core lesson of the past week is that the gap between corporate execution and equity valuation can widen incredibly fast when structural leverage is unwound. The firm is performing at the absolute top of its game operationally, crushing its own internal guidance and generating massive mountains of free cash flow, yet the equity still shed a massive portion of its value in a single trading session because the market's collective expectations had detached from the geopolitical realities of international hardware distribution. To bring everything to a definitive point, the central tension governing this asset is the classic battle between a structural secular demand narrative and a highly volatile commodity cycle. The expectation was that the artificial intelligence infrastructure build-out would permanently break the historical boom and bust cycle of the memory industry, turning this firm into a permanent utility-like monopoly for high-speed computational silicon. The reality is that semiconductors remain deeply bound to global logistics, international trade policies, and the capital expenditure whims of a very small handful of massive corporate buyers. Friday's swift 6.6% drop to $724.66 served as a stark reminder that no matter how impressive a company's product architecture is, the equity value is always subject to the harsh gravity of macroeconomic realities and institutional position sizing. For those managing risk across modern brokerage networks, maintaining an objective, data-driven view of capacity addition cycles will always beat following the emotional swings of the crowd. Disclaimer. This video is for educational purposes only, not financial advice. Please do your own research before investing. Market involves risk. Like this video, comment your thoughts, add share with your friends. Bell subscribe for more updates.